7. Read the CAPM formula and know what each part is doing. 3 layers of return in one formula. Every equity investor expects to be paid for taking risk. CAPM, the capital asset pricing model, introduced by economists Jack Traynor, William Sharpe, John Lintner, and Jan Mawson in the 1960s, captures that logic in a single formula. K is the cost of equity, meaning the return shareholders require. RF is the risk-free rate, the return an investor can earn with no risk at all, typically the 10-year government bond yield of the country where the stock trades. RM is the expected return of the overall stock market in that country. RM minus RF is the equity risk premium, the extra return investors demand for choosing stocks over safe government bonds. V, or beta, measures how sensitive the individual stock is to movements in that broader market. Reading the formula as an investor. Think of it this way. An investor has a baseline. They can always buy a government bond and earn RF with no risk. If they invest in the stock market instead, they accept market-wide risk and expect an additional return above that baseline. That additional return is the equity risk premium, RM minus RAF. But not every stock moves with the market equally. Some stocks amplify market swings, others are more stable. Beta captures that individual stock sensitivity and scales the premium up or down accordingly. A stock with a beta of 1.5 moves roughly 1.5 times as much as the market on average, so investors demand a proportionally higher return. A stock with a beta of 0.7 moves less than the market, requiring a lower return. Part 2. When CAPM needs an adjustment. CAPM measures only one type of risk, the risk that cannot be eliminated by holding a diversified portfolio of listed stocks. It assumes investors are fully diversified and that every risk unique to a single company gets canceled out across the portfolio. That assumption holds well for large, liquid, publicly traded companies. It breaks down for companies with characteristics that beta alone cannot capture. The additional term lambda represents a company-specific risk premium, added when the analyst judges that CAPM alone understates the true risk. Consider 2 software companies listed on the same exchange with similar betas. One is Microsoft, over $200 billion in annual revenue, diverse product lines, 220,000 employees, and investment-grade credit across every market cycle. The other is a newly listed enterprise software startup with 1 flagship product, 3 major customers, and a management team 2 years into the role. Beta treats these 2 companies as equivalent if their stock volatilities are similar. An analyst applying only CAPM would assign them the same cost of equity, which clearly misrepresents the difference in actual risk. In practice, according to research by Bruner and colleagues, 53% of major corporations and 91% of investment banks reported adding a company-specific adjustment on top of their CAPM result. This adjustment reflects risks such as customer concentration, key person dependency, illiquidity of shares, or a limited operating track record. It requires judgment and should be documented with a clear rationale, not applied mechanically.